I'm Taimour Zaman. In this video, I'm going to share with you, if you're a new business, how you can get lines of credit, get access to capital that you couldn't get any other way. You know, last year I did a series of videos on creative and new ways to get lines of credit. We have seen over my decades of experience in investing how, for instance, some businesses can go and buy a shell company that has been in business for, let's say, 10 years. And then once they've acquired the shell company as a parent company, they use the shell company to go get a line of credit. I've talked about various creative ways on how companies around the planet can go get access to capital from North American banks, from European banks, like that. Today, I'm going to share with you one of my creative favorite guys in the world. His name is Edgar. Edgar and my organization, Credit.ai, we've got a long history of working together. I had a fantastic roundtable with creative financiers last year on some specific ways on how they're enabling creative or out-of-the-box thinking to helping companies get access to lots of capital. Today I'm having a one-on-one video with Edgar, getting him to talk about a specific area called insurance and how to leverage insurance to access capital, which I would think is a little bit uncommon. And so without ado, I want you to take your notepad and pen and sit down and take lots of notes. I think if you're looking for lines of credit, you're going to love this conversation. My name is Taimour Zaman from Credit.ai, and I look forward to the opportunity of working with you. Thank you.
Thanks so much for your time today. You've been helping my clients get access to capital that in traditional ways they wouldn't be able to do so. And you're doing that using insurance, which is a very creative way to think about it. Can you tell me, without talking about our clients and business we're doing together, if you were a startup today, how would you go about getting a line of credit? And later on, if you could tell me, if you're a private company, mid-sized private company, what would you do to go get a line of credit? And then the third question I want to ask you is that if you're a publicly traded company, what would you do to go get a line of credit using your decades of experience in the space?
If you're a startup, I think that there's such a myriad ways of looking at these things, because the type of startup is really going to go and determine your ability to go and get a line of credit. There's a lot of fintech companies that go and serve startups around their financing, but it depends on the type of company you are. So if you're a subscription-based company, software as a service, recurring revenue model, or prepaid agreements, you can go to somebody like Pipe. And they're probably one of the best funders that are out there for startups of that type, because you just go and get to go and sell your future revenue base in exchange for cash now to allow for growth. But that only covers that specific type of startup, right? Technology-based software companies with a licensing model. I think other startup companies, the solutions just are not the same. In those situations, and in those you need to, in some respects, almost barter with the borrower, where you would need to go and either give up some kind of a cash security, or you need to go and give a personal line of credit. The part that really just is so difficult for me to go and see is how many founders just go and draw on their credit cards at 17 to 26% interest rates. Typically in Canada or the United States. So ideally, you're able to go and get the money on a much lower basis than that. In terms of being able to go and use insurance in those situations, that again is the insurability of your industry. So startups, I would say, are the most diverse, most challenging places to be able to go and apply an insurance product, because it also depends on the life stage that they are. Like if it's pre-revenue, you are got to go and demonstrate the value of that revenue or be able to go and put up some kind of a contract that can be assigned to a lender, and that kind of gets closer to the domain that you're in, right? So if somebody comes to you with a contract that's backed by SBLC or something like that, you're able to go and get insurance on that, and now you can go and borrow against the insured funding that's going to be coming in the future when you deliver your goods or services as a startup. If I look at it from a mid-market point of view, now things become a bit more interesting because it depends on whether you're a mature and so kind of mostly cash flow churning or low profitability churning company, or whether you're in a growth stage. And it's the growth stage ones that are the ones that really have the biggest challenge. And the traditional lending environment for mid-market is always looking at based on your past performance, and usually go and secure against a percentage of your either tangible assets or your receivables, which is frequently not sufficient to meet the growth investment requirements. In those situations is where some of our expertise at Avasta comes in, which is to be able to identify what is the growth potential of the company, and can that growth potential be quantified? Can that customer base be quantified? And what is the actual driver of that growth? Is it intellectual property in the form of a patent or a copyright that you're selling? Or is it something more perceptual and customer driven, like the brand or the strength of the customer experience that is reliably being delivered? In those situations, these things can be quantified, and then the growth of it can be protected. So there are places in the world that will actually go and allow you to borrow against your brand and trademarks, because there's been you have an ability to demonstrate that the brand and trademark provides a competitive advantage, and that competitive advantage is transferable into the future. So that would be kind of like the mid-market space that's there. And where insurance is valuable is that you can leverage the strength of that brand and customer expectation that you've got and created to be able to go and show that there is value that can be expected in the future, and that your current funding that you're looking for has a certain payback period. So the creative financing aspect of it that's there is that rather than trying to go and argue for a lump sum, we're actually going and arguing for a continuous kind of like a resolution of being able to grow into the customer demand that exists for your company's brand or product and service that you're delivering. And then when you're getting into the larger public space companies, the borrowing side of things that's there is very, very different, because now you have Fitch and Moody's that are typically tracking you. They're going and providing credit ratings on you based on public domain data, plus their own due diligence that they're going and doing. So you're now starting to be much more at the mercy of their rating agency. And that also goes and gives you different types of competitive leverage, because now you have scale and you're able to negotiate from positions of scale with larger financial institutions that have very large funding commitments that they kind of have an internal obligation to be able to find borrowers for. If you're a small public company, especially if you're like a non-major exchange listed company, like you're on over the counter, or you're in a more of a regional or local exchange, things will become much more differently. The difference is that you're disclosing more than a private company would into the public domain. However, your creditworthiness is a challenge because you are not meeting the requirements of a larger exchange. So that is a huge discount or impairment to you if you don't qualify to be on some of the major exchanges in Asia, Europe, or North America. So again, I would say two very different conversations around borrowing that's there. But the same thing goes in terms of the growth standpoint. You want to go and take a look at whether borrowing against an insured ask or growth plan is more cost effective or more valuable to you than going and trying to raise another capital round through selling of a secondary or tertiary round of shares. So that's kind of like the high level summary, I'd say, between the three from what you've asked, Taimour.
Love it. Thank you. There's a lot of companies that have invested in something called intellectual property.
Mm-hmm.
Are there ways that you see companies that are cash poor be able to leverage their IP to access capital?
Yes, there are. The difficulty with intellectual property is who is making the money off of it and how. Most companies do not actually know how much of their revenue is generated by their intellectual property. They are typically leveraging standard reporting practices, mostly grounded in accounting. I went and generated $1 million in revenue. Okay, great. Well, why did you generate that $1 million in revenue? And they're like, oh, it cost us $600,000 to make it, and we managed to mark it up $400,000. It's like, no, that's still looking at it from the internal point of view. Why did people pay $1 million for what they went and bought from you? Is it because you managed to take $600,000 worth of expenses and make it readily available for them, and they were willing to pay a $400,000 premium for that 600, right? In terms of the convenience, or is it something else? And by the way, that can be intellectual property. Your ability to go and convert $600,000 into $1 million worth of value, that is an expertise. Now, is it transferable? Is it scalable? Is it sellable? That's what turns it into intellectual property. And most organizations don't know how to document it. They're not trained to do so. We don't have an economic environment that is focused around establishing intellectual property. Or we're in the trap of thinking that intellectual property falls into the three most common classes, which is patents, trademarks, and copyrights. And usually we don't go and give an itemized bill to a customer that goes and says, oh, thank you for purchasing this $10,000 good from us. This included, $800 worth for copyrights. It included $20,000 for patents. It included, $3,000 for patents. It included $1,000 for raw materials. We're not giving that itemized bill. Now, if you want an itemized bill, go and get yourself a medical procedure in an American privately owned hospital. They will go and tell you every single little piece that you went and paid for, and how much they felt they could charge for it. So, because our customers don't buy itemized, ironically, we don't sell itemized. And what we go and recommend for our clients to go and do is internally be very clear on what you're selling and why you're selling it at that price. Are you leaving money on the table? Are you at the risk of being able to lose money because you're actually selling for something for more than the marketplace would be willing to pay once they became aware of the underlying costs or alternatives that is there for your product or service? So that's a lot of the kind of like the IP reconciliation that we're going and doing in our work. I would say the smart startup, the smart mid-sized company is actually able to explain to themselves why our product or service is able to be sold for that amount and what the components are, rather than saying, oh, well, we went and priced it at this level because it costs us this much to deliver, and we have a target margin and profitability on it.
Got it. I love it. Very cool. Very cool. Tell me some of the most creative financing stuff you have either seen or done in your career so far.
I would say one of them is, I'd say the most creative or the most valuable ones. I'll go with value and how the creativity kind of fulfilled it. What business owners, whether they're executives or public companies or private companies or startups, are looking for is that they want to spend as little time as possible worrying about the money down the road. So most of our creative financing solutions have been so that money and liquidity is not a problem for the borrowing entity for 2, 3, 4, 5 years, regardless of what the growth is that they're looking for. So much of the creativity that I've got kind of built in, or if I went and worked on the credit submission or advised on if it was between two different other parties, is not just take a look at what the immediate borrowing requirements are, but also actually account for what the expected borrowing will be over the next 2 to 5 years, and establish the milestones that have to be hit to qualify to go and make that borrowing request, and then pre-build it into the borrowing structure. Most lending institutions do not operate this way because the type of information that is required to make that possible is not in their credit submission ask, let alone the borrower's knowledge or aptitude to prepare. And that's just, I wish it was different, but that is the unfortunate reality of legacy systems that have just kind of been tweaked and adjusted over the years from the lending institution side, whether it's private or public or traditional banking. And the same thing with borrowers not being able to actually know why they're able to go and make money today or tomorrow. So that would be my summary on that statement.
Who's disrupting the investing lending business from your perspective beyond the work you and I are doing?
Fintech. They're going and getting funding for very clearly articulated use cases, like my description around Pipe. I think it's bloody brilliant in terms of their business model. And I think that the more organizations where there's a clear definition of the revenue stream that is being established for them by type, I can see more Pipe-like organizations coming out and being able to go and fund against that. The other thing that I see as an emergence of is a specific asset class lenders who only lend against that specific asset class. Kind of like the traditional domain around that has actually been like large scale real estate. We've had that for a very long time in terms of that specialization. However, we're now going and seeing it with what Pipe is doing in the SaaS space. And what I think is possible to go and do is the same thing in the brands and patent spaces. There are some organizations that lend against them, but they just haven't reached size or critical mass, primarily because of the fact that the borrowing community doesn't even know that it's possible, let alone managing their business assets with that mindset in mind.
Very cool. Edgar, for people that are interested in hiring your firm as a consulting firm, what do you guys do and how does somebody reach you?
It's pretty straightforward. We use measurement to identify how your customer base is able to generate your business value. And that ends up being an ingredient into building measurement systems to look at your customer value that you can go and manage internally. We provide professional training around that for people who are interested, including our own clients. We apply the same expertise in board reporting around the holistic value of a company. And that expertise, those two combined, is used a lot for M&A on sales side. So you want to be able to go and sell your business with typically, like, I'd recommend an 18 to 36 month outlook. Or you've just bought a business and you want to make sure that you integrate it successfully. Ideally, you retain our services before you buy the business as opposed to after, because it may not have been the type of business that you wanted to buy based on the intersection of the customer bases. I find much of what we go and do is making assumptions in these acquisitions. And we're here to avoid making assumptions and guesses, and we're here to provide that measurement. So we go and do that as transactions, or we do them as advisory agreements. And you can go to avasta.co, and you can also find me at my Twitter handle at Edgar Baum, Baum. Those are probably the two fastest ways to be able to get a hold of us.
Love it. Thanks, man.